On today's episode of Options Deep Dive, we're going to be talking about implied volatility and standard deviation. And we're going to watch this video together, and I'll give you my real world perspective to go with their educational theory on these videos. So let's watch this and learn more about it.
See those probabilities expand on those outer wings of the strikes. So we're going to talk about exactly how that happens today, what implied volatility really implies, and how we use standard deviation to put context around implied volatility. So on the very first slide here, we're just going to talk about what these two things are. So if we review what implied volatility is, it is a metric that's derived from option prices. It's not something that we know and we input into the Black-Scholes model. It's
Okay, I'm glad you mentioned that. So let me log into Trader real quick, and let's talk about what the prices are. Right, when you have options pricing, you have extrinsic value and you have intrinsic value. Remember, intrinsic value is how much moneyness a stock has. And once I get logged in, I'll show you in just a moment here. Intrinsic value is the difference between the price of the stock and your strike price. So if the stock is $160 and your strike price is 155, it has $5 of intrinsic value. Now you can't buy it for $5. You cannot do that. It is not allowed, right? There is what I would like to call the uncertainty value that goes along with every option, right? The uncertainty value shrinks as you get closer to expiration, just like if you were to buy an insurance contract, right? Your insurance, if you were to buy it for one day, maybe $10. If you were to buy it for 1 month, it might be $300. If you were to buy it for 1 year, it might be $3,000, right? Because there's greater uncertainty over the course of a year versus over the course of one day. So your extrinsic value will always be higher the further out in time you go. Now, to the point that that Mike was making just a moment ago, is that implied volatility gets baked into extrinsic value. Because remember, intrinsic value cannot change. It is always the price of the stock minus your strike price. Always. So let's just do a little calculation here to prove my point. So if we say the price is 37.17 minus 35, 37.17 minus 35 should give us an intrinsic value of $2.17. Who would have thought? Now, there is what I like to call the uncertainty value to go on top of it, because you can't buy, it's 257 right now. You can't buy it for 217. And that is additional extrinsic value. Extrinsic value includes theta, so the time decay. It includes vega, which is your implied volatility. It includes rho, which is your changes to interest rates, which doesn't matter, so don't even worry about that. But implied volatility is not given to you. It is more a backwards calculation, because we know the intrinsic value. We know the intrinsic value. We see the price that it's trading for. So therefore, we have to basically derive. We have to derive what the implied volatility value is from what we can see right there. Okay, everybody good?
It's actually something that comes out of all the other variables that we do know, such as the option.
So, John, here's what I'd like everybody to do in the chat. John, I can tell you for a fact that with $250,000 in the bank, if you have had the returns like I've had this year, I'm up around 50% right now. You're going to do great. You're going to do great. I can't guarantee you that you will get the returns that I had last year. I had 92%. This year, I'm around 50% right now, thanks to playing ETF, coming to town, paying us bucks. But what I'd like you guys to do in the chat is let John know. Let John know. No, don't listen to me. Let John know if he would be successful as an outlier. That's what I'd like to know.
Options price and how that's affected in that Black-Scholes model. We can solve for implied volatility or get very close to implied volatility, or what is perceived as that implied volatility. So what is this implied volatility value anyways? Well, it really is just an indication of perceived future volatility of an underlying. So it's really interesting in the sense that we use this underlying's option market to determine what the perceived future volatility of that underlying is based on the price action of the options market.
Cheers to Crispy. Just going to put that out there.
So when we're looking at implied volatility, we're really looking at the expressed one standard deviation percentage on an annual basis. So as a quick example, if I've got a $50 stock and that stock has a 20% implied volatility, that means that over the course of a year, we have a $50 stock that has a 20% implied volatility, which would mean it would range 10 points to the upside or 10 points to the downside, with a 68% probability or 68% of those occurrences would occur within that range.
Okay, so what I want to do is I want to pull up a bell curve. Bell curve. So when I worked in consulting, which I did for 12 years, we talked a lot about what's called the bell curve right here. So this is your implied volatility curve, is what they're trying to measure here. So remember, we've talked about this many, many times. The implied volatility, the uncertainty value, is highest at the money. So if we were to look at this, right, we would say the implied volatility would grow, peak here, and come back down. That was a decent curve right there. Okay. 68% of that implied volatility happens within one standard deviation. Now that applies to every time you have a bell curve. 68% always happens at one standard deviation. Now, the reason I want to bring this up is when I was working at consulting, this is something I talked about all the time on what is called decay rates of accounts, right? So every institution over time has to, every financial institution, or let me back this up. So I worked for 12 years working directly with credit union executive management, and one of the things that we worked on were the decay rates of their accounts. So, for example, if there were 100 depositors at your account on January 1st, how many of those depositors lasted until December 31st, right? There is a decay rate on a monthly basis, and it is in a asymptotic slope, meaning it will go down over time. We know this, but it will never cross under zero, right? Now, a financial institution, a depositing institution, needs to make sure that they maintain the number of depositors, of course, right? That's how they make their business. People deposit money there, they go loan it out, they keep the spread between how much they loan it out for and how much they're paying in interest, which is basically nothing and has always been for since 2008. Now, 68% of the time is one standard deviation. 95% of the time is two standard deviations. And the way that I ran all of my decay studies was a three standard deviation, which is 99.7% of the time, we're going to find a decay rate that is less than X value, right? Maybe it's 1% per month, maybe it's 1% per year, right? Every institution is different. So in this case, what we're trying to do is figure out what is the greatest point, the highest amount, the most likelihood that we're going to hit this area with one standard deviation. Now, these people do sell options. That is their whole core tenet here, right? So what they're saying is if you sell an option and it falls within this one standard deviation range, that's likely to be in the money. But if it's out of that one standard deviation range, it's unlikely to be in the money at expiration. Therefore, you make more money when you sell the options. So don't sell the options, just buy the deep in the money long calls. All right. But this is something we should talk about. This is Options Deep Dive Wednesday. So let's jump into it. By the way, as Senior Wahoo saying, everything we do, all of the great information is included for only 82 cents a day. And I think Nick totally nailed it on the head. John, welcome to your new job as a fund manager. Congratulations to you, John. You actually just got a promotion, a very lucrative promotion.
So we're looking at a one standard deviation annual expression that's a percentage, and that's just the implied volatility. It's not guaranteed. It's not anything that should be taken for the literal meaning for it, but it's just a gauge to see where the prices of the options are indicating that that stock might go. So when option prices are higher, implied volatility is going to be higher. And when option prices are lower than they normally are, implied volatility is going to be lower as well. And implied
Now, remember, when he's saying when the prices are higher, the prices are lower, the only thing that can determine that is how much extrinsic value there is. The intrinsic value is just A minus B, but the extrinsic value is what's going to pump up the actual bid and ask price.
volatility is obviously a living, breathing thing. It can change and does change every single day. So what are these standard deviation values that we keep referring to? Well, standard deviation is really just how occurrences deviate from the mean of the occurrences. So if I've got 10,000 occurrences that I've randomized through that same exact stock, we're usually going to see a lot of smaller movements. So we're going to see a bell curve where a lot of the smaller movements are going to occur just around that 50 strike, maybe 49 to 51. We'll see a ton of occurrences there. But we're also going to see those outlier movements that go all the way to 100 or maybe go all the way to zero, or when their stock would theoretically go bankrupt. So we're looking at the standard deviation of those occurrences, and we're really just putting context around where those prices are. So when we're looking at a one standard deviation level, we're capturing the range of 68% of those occurrences. So one standard deviation would be on the upside and
Okay. So let's look at a chart. What they're trying to say here, and this goes into what's called the random it's not random walk theory. What is that called? God, efficient market theory, the efficient market hypothesis, which is absolutely a theory. It is absolutely a hypothesis, and I'll prove it to you right here. I'll prove it to you right here. So we would say that the SPY. Now, unfortunately, I can't see historical options chains, but for example, let's say that you went with one that's 23 days to expiration and it has a 64 delta. Okay. So we're looking at the SPY with 23 days to go. 23 days ago, so let's use our measuring tool. 23 days ago was here. Well, it was a weekend, so we'll say right here. Okay. So on Friday, September 12th, Friday, September 12th was 23 days ago from the time of this recording. Now, SPY has gone up by, well, let's go to the top of this candle. It'll help reinforce my point. $15. Okay. So that means that SPY went $15 in the money. SPY going $15 in the money. And this is the best I can do considering I don't have the historical values here. SPY going $15 in the money. In fact, hang on. I got to scroll a little bit on this. 669 plus 15 is 684. So SPY going $15 in the money, 684, okay, from 669 to 684, $15 in the money. There's a 26% chance of that happening. Yet that's exactly what happened. What just happened? What just happened would have fallen not in the one standard deviation. What just happened would have fallen into the two standard deviation move. Let me ask Google this. How often, you're going to love this, does a two standard deviation event occur? Hold on. There's like a term for this. 4.55% of the time. Okay. That doesn't sound right. How often does a two standard deviation occur? One time out of every 22 outcomes. Okay. But he's saying that it should happen, 60 something percent of the time, right? Unless I'm misunderstanding, right? No. The thing is that the random walk theory, the efficient market hypothesis, is not a reality because trends do exist. What just happened right here, according to the people at Tasty Trade, can't happen. Except for, 1 out of every 22 times, so less than 4% of the time. Yet that's exactly what just happened. Now, do you think if I went back 22 days, we'd see a similar event? Yeah. Do you think if I went back 22 more days, we'd see a similar event? Yeah. Do you think if we went back 22 more days, we'd see a similar event? Yeah. Do you think if we went back 22 more days, we'd see a similar event? Yeah. So we probably could have seen a similar event that happens 1 out of every 22 times, 6 times in a row. Wait. A one, so a less than 5% chance of happening just happened 6 times in a row. Wait a minute. You're telling me that markets aren't efficient? This is why Chris this is why Chris can't talk. This is why Chris blew up his account twice. Because I believed the efficient market theory actually was a thing. I believed that the efficient market hypothesis was reality. What we see right here blows the efficient market theory up 6 times in a row. 6 times in a row. 6 times in a row. That didn't happen. And what about to the downside? Probably happened 2 or 3 times in a row. So where I'm trying to go with this is that you're going to hear people talk about how it's a random walk. Prices are random. Yes, the individual day price is random. Just like when you put on a trade, the outcome is going to be random. It's going to be either a win or a loss. Okay. We can't control how big of a win it's going to be, and we don't want to. We want that thing to run. We can control how big of a loss it's going to be because we've already set our position size and we've already set our stop losses. Okay. So there are 4 possible outcomes: big win, small win, break even, or small loss. There's never an opportunity for a big loss. Never. And that's why position sizing is so key. Because even if something gaps down against you, by position sizing, you can still survive. So, and Scott will agree with me. Scott has also proved that the efficient market theory is just a theory, it is not reality. So when you hear people talk about the implied volatility, when you hear people talk about how occurrences deviate from the mean, et cetera, right? We just proved with like a couple minutes of work that the efficient market theory is not real because they don't want to believe trends exist. The trend is there. The 10 is over the 20, price is over the 50. That's it. Now, does it mean that every time the 10's over the 20, price over the 50, it's going to run like this? No, because there are times where it's going to go sideways. Okay. So there's your efficient market theory at work. It went sideways. But when a trend exists and it can blow through this, it'll blow the efficient market theory right out of the water.
The downside of that bell curve, and we're really just looking at what levels would capture 68% of those occurrences. 2 standard deviations would capture the range of 95% of those occurrences. So we're capturing almost all of those occurrences. We do have a few more outliers beyond that, but when we're looking at 2 standard deviations, we're pretty much capturing the essence of what is implied or what could potentially happen, which
Oh, Papacito, I totally missed this. Hey, first off, I don't want you guys to ever feel like you need to send me a super chat, but I want you to know I really appreciate that. I watch other channels and they only speak to people who super chat them, and I feel like it's super gross. So I don't ever solicit super chats. But I want you to know, Papacito, you are an awesome rock star. I know you hate them. Your channel is based by all definitions. I'm totally based, but your channel is based by all definitions. You get less views because your channel's sophisticated. Thank you, my dude. Right, we want to talk about the reality here, right? We're not just talking about theory. The theory is that the efficient market theory is a thing. The reality is it's bullcrap, right? People love the idea that, oh, I can follow implied volatility curves and it's 68% of the time it's going to work. And we just proved 6 times in a row your 68% of the time is garbage. All right. So yes, the channel gets less views because of that, but hopefully someday we can encourage more people to be like Matt Barnes, Houston realtor and fund manager. Maybe one day we'll get more people who are also realtors and fund managers. When you're deep in the money, call options, and your position hits the ATR recommended you roll up, do you need to readjust your 2 ATR stop according to your new position? This is a deep question, a very, very sophisticated question, as Papacito would say. And that's why Matt is a fund manager. So let's go to the slide real quick for Matt. I got you, Matt. So we pull this up. We're not normal. We are outliers. Let me go to that slide. So when we're rolling our positions, and where's that slide? Yeah. Oh, that's right. It looks different now. I was looking for something else. When we roll our positions, we're looking to see it go up 1 ATR. So in this example for SPY, it would have gone up multiple ATRs. So you could have rolled it many, many times, completely eliminating all risk in your position, 100% of your risk. You could have banked so much profit on the way up and not ever have any sort of risk in this trade and only guaranteeing profits. Okay. Every time a stock moves 1 ATR in your direction, can you roll up and or out for a credit? You must take in a credit. Otherwise, you're adding to the risk. If you do it for a credit, you're reducing your risk. And then you would keep the same planned exit points. So to Matt's question, would you use a new 2 ATR stop? No, I am on my plan, right? Consider your own plan. Consider your own plan. I would not be changing the exit signal. So on plan M, these exit signals would remain. This 2 ATR stop would be from entry. This 3 ATR midday emergency exit would be from entry. So great question, Matt. Really appreciate you. Let's get back to the video.
which is why we look at these values in the option market. We like to look at one standard deviation ranges when we're placing new trades, and usually when we look at two standard deviation levels, it's usually an indication of perceived max loss. So like when a brokerage is looking at calculating a buying power reduction or a margin on a certain position, they might calculate it from two standard deviations and gauge it from there depending on a person's profile in their account or whatnot. But when we're
Oh, look at this. Thank you, MT. That's the kind of stuff I was looking for right there. The odds, and we're gonna blow up this video. I really don't want to. I don't know how much of this we're gonna watch because the efficient market theory doesn't work, right? Because the odds of this happening 6 times in a row is 1 in 244 million. 1 in 244 million chance that we would see the SPY break through its one standard deviation move 6 times in a row. Well, but the markets are efficient, right? The markets are efficient, and because of that, you can sell calls against it because it's always efficient. I'm trying to be that guy from Office Space. Y'all know what I'm talking about with the red stapler. Haven't you heard that the markets are always efficient and that it must stay within the one standard deviation range? I was that guy. I was out of shape. I was overweight. I was that guy in corporate life, thinking the markets are efficient. It must stay within one standard deviation, and I blew up my account twice. So you get to choose. All right, I'm gonna leave the choice up to you. Type in number one if you want to be the guy who believes the efficient market theory that prices have to stay within this range, right? There's all the data in the world to support that prices have to stay within this one standard deviation range. Or type of number two if you want to be an outlier because you understand that things like this actually happen. You want to be the one who's taking advantage of this and taking this all the way to the bank over and over and over again, because what just happened here, we're living in a very special 1 out of 244 million time chance. You tell me. You tell me. You tell me. So you're saying there's a chance. You tell me. Yeah. I would rather give you the tools to be successful in the markets versus trying to convince you that the efficient market theory actually is a real thing and you actually should sell options because you actually are going to make money 68% of the time. The truth is, if you had tried that strategy here, selling calls, because I did it and I can speak from experience, and that's why I'm so passionate about it. If you try to do that, because the sexiness is there, I understand the sexiness, but if you try to do that over and over and over, you would be absolutely destroyed. Your account would look like mine did twice because I thought I was smarter than the market, rather than listening what the market is telling you, rather than listening to what we talk about on a daily basis for free here on YouTube, rather than using the data in Outlier that costs just 82 cents a day when you get the annual plan. And rather than taking advantage of this and watching generational wealth pour into your account, you would rather put up a fight and say, no, trust me, bro. It can only fall within this range. Yet, what we just saw would happen 1 out of every 244 million times. So where am I going with this? Implied volatility, it's a thing. It will change the price of your options. How do you mitigate that? You go deeper in the money, right? Forget all the other nonsense. Just go deeper in the money, right? Implied volatility will peak. Let's focus back on this. Implied volatility will peak at the money. Let me do a new one. Implied volatility will peak at the money, and then it will go down the further out of the money you go or the further in the money you go. So just go deeper in the money. Just go deeper in the money, and then you don't have to worry so much about you don't have to worry so much about the implied volatility because it's already coming down. And for me, what I want to see is the extrinsic value be roughly 20% of the price of the option, or less, or a little bit more. My absolute cap is 30%. I will not go more than 30%. But if it's 20%, that's outstanding. If it's any less than that, even better. So like this one right here. This is $4.08 over $38-ish. So that's going to be roughly roughly 10%. So 4.08 divided by 38.94 is roughly 10%, right? So 10% of this option price is extrinsic value. Okay. So the implied volatility is almost negligible. It's almost not even there. And we're not going to do any don't trust me bros anymore. No, 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 no. All right. So we're going to wrap on this one here because what I want you to remember, what I want you to take away from this is the efficient market theory is just a theory. All you have to do is look at any chart and see a big trend like this, and it blows the efficient market theory out of the water. It doesn't exist. It was created by smart people who wanted to sound even smarter and wanted to basically take money from people who thought that they were smarter than them and therefore could charge, unbelievable, ungodly amounts of money. Or you could look at the reality and that trends do exist. Your job is to go with the trend, right? All stocks are bad, but every once in a while they act right. And if you're ready to save time, make money, and start winning with less risk, click one of these two videos, and we'll talk soon.